What's up, buds? Today, talking about some of our options moving forward as it applies to our income generated from multi-unit properties. This is mostly to point out there's not one set way to take on this approach. So, first, what we'll talk about is increasing rent payments, followed by decreasing your monthly costs. And the last thing I'll mention is some lump sum options that may make some conservative investors' ears bleed a little bit, but it's still an option out there for you. Again, just so that you see that there's different approaches to this process. So, first, increasing the rent. This is very market driven. Basically, this option is not totally up to the property owner. You'll need to stay on top of market events, trends, especially in your area. So obviously, we're in a high inflationary period right now. So something you're going to want to think about is, are your potential renters' incomes matching that inflation? Right now, might be safe to assume that it's not matching it or it's barely matching it right now. So this seems like it would be the easiest way to bring in a higher revenue. It's highly sensitive, as I'm saying, to these market forces. And, just one quick note from our personal experience. We were lucky enough to be in a rental unit that was charging below what this market rent could have been. And that was an extreme help to us in preparing to purchase the property that we are currently purchasing. So I probably have a more biased opinion or thought process in terms of rental increases, but I definitely do think there's something to be said for, paying things forward a little bit. So next, what we'll talk about is decreasing your costs. And in this approach, you're going to have more control over it as compared to increasing rents. And I say that you have more control, meaning that you're going to have more options available to you. The first thing I guess I want to talk about is your taxes, which is something you won't have much control over. At the end of the year, your mortgage servicer is going to review your escrow account, and what they do is they make sure that there's enough funds in there to cover all of your tax and insurance payments for the upcoming year. So if your taxes go up, obviously now your monthly payment's going to go up. Or if you have a shortfall in your escrow account, that payment is going to go up a little bit to make up for that shortfall. Now, I know people probably know by now that we are experiencing a rising interest rate market. So buying into this market is going to give you an option to refinance at a lower rate when the markets change. That's just very straightforward. If rates are in the sixes, they go back down, you can get it into the fours maybe. So, that right there is an option where you're going to reduce your monthly payment by a good amount. The next thing I want to talk about is PMI payments, and that's something we will definitely be focusing on first. So we're going to be in FHA loans. What that means is that there's going to have to be a PMI payment. Every FHA loan requires an upfront PMI funding fee plus a PMI monthly payment. And what we can do here is we can refinance into a conventional loan that would either severely drop what our PMI payment is, or it could eliminate it completely. Now how does that happen is, say over time as we're paying down the loan balance or as the property values increase in value, we can refinance into that 85% loan to value that we've mentioned in previous videos. The last thing I want to talk about is resetting the clock. And basically what that means is you can always just, go back to a 30-year term. And if your loan balance is like going down and down and down, you reset the clock. Now your monthly payment is going down too. So, as you can see, decreasing your costs, there's just much more options out there as opposed to just straight rental increase. The last thing I'm going to talk about is the lump sums. So if you do a cash out refinance, those funds are tax free. If your property is self sustaining, meaning that the payments cover the mortgage and you manage a proper safety net for improvements and wear and tear, you can cash out your equity and use it however you want. People in the real estate investing world refer to this kind of as like an oil rig approach. So it just keeps chugging and gives you returns over time. So I hope everyone liked this video, and I will talk to you later.